Hello, everybody. Uh, we are here to learn mergers and acquisitions as a topic of CA final SFM subject. One of the most popular topics from examiner's perspective. You can be very confident that in your paper this topic is going to come. Second, if you speak from logic, common sense, interest point of view, this is one of the most beautiful topics where you can apply your brains. Why? Simple fact. Statistics says 2012, 2013, 2014, which are the last 3 years what we have. 2012, in India alone, there was a $40 billion mergers and acquisition deal. 2013 was a bit sluggish. It was grossing around 30 billion, and this was very good. It was a whopping 45 billion mergers acquisition. One of the biggest credit for 2014 went to that Sun Pharma and Ranbaxy mergers and acquisition. Mergers and acquisition in itself is one of the most valuable corporate actions which happens in corporate life on a regular basis. I bet that you just buy today's newspaper and you check out, you'll be finding some of the other merger and acquisition deal. In the post 80s, mergers became most popular worldwide. India, 90s was the era, post 1991. But are we interested right now in those statistical facts? No. If we speak about merger and acquisition, then guys, the first point is we are least concerned about the accounting aspect, whether it's in nature of amalgamation, absorption, whether we are making a consolidated company, whether we are acquiring 50%, whether we are acquiring 20%, whether we are making a subsidiary. Those things are not mattering to us. Why? A simple fact remains that to us what matters is the pre-thoughts. I repeat, is the pre-thoughts. The word pre is important. Is the thoughts which are to be applied prior to mergers and acquisition. Use your brains. In amalgamation, in absorption, you used to come across the number goodwill, if you slightly remember. In accounting entry, in that business purchase entry, goodwill comes as a debit side. On the debit side, it comes as a missing figure. But if you apply slight brain of yours, we can sure of that in reality, how can goodwill be a balancing figure? How is it even possible? When Sun Pharma must have acquired Ranbaxy, it must have already known well in advance that how much more over Ranbaxy's value is Sun Pharma paying them. It's quite common sense. If I am buying a company, let's say I am an acquirer, the buyer company, and there is a seller company that's called as a target. If I'm an acquirer, that's a buyer company, I'm going to acquire a seller, that's a target company. It's not possible that goodwill could be a missing figure. It's bluff, it's stupidity. The common sense says that when I am going to acquire the target company, let's call it Sun Pharma, let's call it Ranbaxy. When I'm going to acquire Ranbaxy, well in advance, I'll be knowing how much am I going to pay above Ranbaxy's worth. It's quite common sense, right? Right? So the point of the day is, in this topic of ours, in SFM as a subject, we are doing all the preliminaries. We are doing all the preliminaries. I hope you got it well. Right? Other fact, number one was how much to pay. Purchase consideration. What to pay. It could be based on cash, or we could have a stock, share to share deal, exchange ratio, right? And this could be even a combination. Maybe we are buying the target company and offering them cash as well as shares. As soon as I say that we are buying the target company and we are paying them shares as well as cash, your first question that your brain should ask you, how to know how much shares to give? I repeat, how to know that how much shares to offer? And that we call it as swap ratio. That we call it as a swap ratio, or much simpler version of it, exchange ratio. That we call it as an exchange ratio. Primarily, the job will be revolving around these two factors, goodwill and swap ratio. Okay, I'm sure. Now, further details. Further details. For understanding the topic, I repeat, most interesting fact is goodwill. For understanding the topic, we are more concerned. I repeat, we are more concerned towards understanding what does. I repeat, what the word is what. What does acquirer company look in target company? Look in the seller company. What did Sun Pharma look in Ranbaxy while the merger was happening with it? What was that? What happened in the Kotak and ING Vestia deal? What was happening over there? The most important, mark the word here, the most important driving factor to entire mergers and acquisition deal is called as a synergy. As I call it, synchronized energy. As I call it, synchronized energy. The most important driving factor in the whole world of mergers and acquisition is synergy. That's called a synchronized energy. Again, the new question should be, so what is synergy? Guys, synergy is the item, is the benefit, what the acquirer is looking for while acquisition. When you buy an asset, from Sun Pharma point of view, Ranbaxy is an asset, Ranbaxy is a business. When Sun Pharma is trying to acquire Ranbaxy, the Sun Pharma company is looking for synergy in Ranbaxy. Question number 2, but what is synergy, sir? In theory, synergy is called as a 2 plus 2 equals to 5 effect. Wonderful, right? 2 plus 2 equal to 5 effect. I'm in proper state of mind, don't worry. 2 plus 2 equals to 5. What is 2 plus 2 equal to 5 effect? How is it possible? 2 plus 2 equals to 5 effect here implies that when two companies merge, their value of the combined entity, their merged entity's value will be far higher than what they were standing independently. Yeah, what is the sum total of their values when they stand independent? I repeat myself. It could be like this. Sun plus Ranbaxy, when they stood independent, the merged entity will be far much valuable, far much better than what they stand alone. Yeah, what is the sum total of their independent entities value? Beautiful, isn't it? The question is, synergy is the most important factor in which any merger and acquisition deal gets driven out of. Question, so what are the types of synergy? This is again a very interesting fact. What are the types of synergy? It can be categorized into 4 types. There could be sub-classification. I categorize them into 4 types. And those are wonderfully explained. Number 1, just check it out. As far as synergy is concerned, we can classify them into 4 types. Sales synergy, economies of scale. I can go for economies of scale, yeah, cost synergy basically. We can get into financial synergy, SFF subject, financial synergy. And last one, we can get into tax synergy. Important, but not, it's not the epitome of it. The question, so what are these synergy all about? The most important synergy, guys, it's common sense. Most important synergy, what any company is looking into is sales synergy. The most important synergy what we are looking into is sales synergy. Let me give an example. When I use the word chocolate, I am 100% sure the first word strikes to your mind is Cadbury. Yummy? Dairy milk? I think it's a silk chocolate, right? But the question is, Cadbury is the generic name. I repeat, generic name. Even Nestle is a good chocolate maker, right? Girls, boys, Nestle is a good chocolate maker, isn't it? Maybe you find Cadbury much better. But the question stands here. Question stands. Heard Toblerone? Heard of Tang? Right? Guys, Cadbury, a UK company. Our history says we are developing from UK. So the question is, Cadbury, a UK company, having loads of control. I repeat, loads of control on two populous market. That's India and Brazil. I'm least bothered about Brazil right now. But the question is, India? Talking about India, a population of 25 crores or more. So Cadbury, a UK company, having as far as I can say a kind of a monopoly in India and Brazil, having a huge market share. The question is, a bigger company called as Kraft Foods trying to acquire, which is a US company, it's a US giant. Kraft Foods, which is a US giant, trying to acquire Cadbury. Argument why? Kraft Food tried. You must have seen the ad of Oreo, the biscuit. Very interesting. Oreo biscuit. Again, girls. So Oreo biscuit. So Kraft Food was trying its level best to enter into Indian market, but public in India, people in India are just fond of Cadbury. The question stands: to drive out the competition from the market, Kraft Food simply acquired Cadbury. I guess it was a $20 billion deal. Question stand: what happened? The combined entity now has a larger market, has a bigger market. Kraft Food has a better sale. Dhanda bada. Sales has increased. Sales has increased incredibly. Right? Question over here. Economies of scale. Now when you talk about the economies of scale, cost synergy. Basically what are we talking about? It's cost synergy. By acquiring another company, we are trying to save on our costs. Guys, in the Sun Pharma Ranbaxy deal, mark the number. In the Sun Pharma Ranbaxy deal, Sun Pharma itself publicized that by acquiring Ranbaxy, they are going to save $250 million in salary every year. They publicized on this number that in this deal they're going to save $250 million every year. Now think about this. By acquiring Ranbaxy, by merging Sun Pharma and Ranbaxy together, they are saving, the merged entity is saving $250 million each year in salary alone. We have not even spoken about the increase in the sales, the reduction in other things. Only salary, one of the most important components, it is reducing by $250 million. So some huge amount. That's economies of scale, right? Financial synergy. I'm sure you must have heard about the company Glaxo Pharma. It's popularly known as GlaxoSmithKline. In the early 90s, one of the biggest mergers in the pharma industry, I'm sorry, late 90s, pardon me on that, 90s, late 90s, 99 precisely. GlaxoSmithKline was a firm. It was actually two different firms. And what happened is all we know. The firms merged and today we know them as GlaxoSmithKline. Question, Sensodyne, I think Sensodyne is a product of Glaxo. What is it all about? One of the most driving factors in this merger, guys, if you give me permission to enter into finance much deeper, of course that's our subject, huh? Guys, one company had a better credit rating. Focus on this. One company had a better credit rating. The another company had, let's say, not that better. So I'll just go for a reasonably okay credit rating. So poor, I just don't want to use the word poor. You can say reasonably okay credit rating. Now what happens? How does the fund of credit rating work? If the company has a higher, superior credit rating, its cost of capital is always lower. How come? It can raise funds in the form of debt at a very, very lower rate of interest. I repeat myself. If the company has a higher credit rating, it can raise funds at a very, very nominal, lower rate of interest. But the firm which has a poor credit rating or not so good credit rating has to have a higher cost of capital. When these two firms merged together, the resultant was GlaxoSmithKline. It was Glaxo Wellcome, SmithKline Beacon. Today we know GlaxoSmithKline. And the merged entity had a very, very superior credit rating, leading to overall reduction in cost of capital. And when the cost of capital goes down, everybody has learned this, when the cost of capital goes down, the value of the firm increases. and that was the primary motive of synergy, right? So over the cost of capital went down and the value increased, financial synergy. And the last case, as a chartered, I don't think much of an explanation is required to you. Tax synergy. I have a case. JSW Steel tried to acquire its own group company. JSW Ispat. In the year, JSW Steel had very, very high profits. JSW Steel acquired JSW Ispat, which was actually a loss-making company. I think you must have got it. So JSW avoided its own tax payment by acquiring its own subsidiary company, which was having its own group company. Sorry about that. Its own group company, and avoided a huge tax payment. This is an introduction to synergy. As we see, there are four: sale, that's revenue; economies of scale, that's cost; financial synergy, trying to reduce the cost of capital; and the tax synergy. The classification is just for a student to learn. A single merger can single-handedly cover all of them. So when I say they are classified, they are not stand alone. A single merger could have all of them. For a classroom understanding, we have to segregate them. I'm sure you enjoyed your session. See you soon. God bless.